Imagine you're holding $5 million of a single stock with a small amount of cost basis. If you were to sell it all today to Diversify, you could be looking at a tax bill north of $1 million. So what do most people do? Nothing. And that might be the most expensive decision of all. Today, I'm going to be comparing two tools built to solve this: exchange funds and direct indexing SMAs, plus a third option most investors have never heard of. I'm Dylan Cole, a partner and private wealth advisor here at Blueprint Financial Group. And most of my work is with closely held business owners and clients holding large, concentrated stock positions. So this problem crosses my desk constantly. Here's the trap. Concentration got you rich. Concentration is also how people get unrich. A single stock can drop 50% and stay there for a decade. The textbook answer is sell and diversify. But when your basis is low, the IRS is standing in the way, federal capital gains, the net investment income tax plus state tax on a $5 million position with a low basis, the all-in cost could potentially run you north of $1 million. So you're stuck between two risks: the market risk of holding and the tax cost of selling. Everything in this video is a different way of threading the needle. Let us use one example investor throughout. We'll call her Sarah. $5 million in one stock, $500,000 worth of cost basis. She wants out of the concentration without lighting $1 million on fire. Option 1, the exchange fund, sometimes called a swap fund. Not the same thing as an exchange traded fund, completely different animal. Here's the concept. Sarah contributes her $5 million of stock into a partnership. So do dozens of other investors, each bringing their own concentrated position. In return, Sarah receives a partnership interest and the whole diversified pool. And here's the magic. Because of how partnership tax law works, the contribution is generally not a taxable event. Sarah just went from one stock to a diversified portfolio without having to sell anything. Now the fine print, and there's a lot of it. First, the 7-year lockup. Leave early, and she typically just gets her original stock back with nothing accomplished. Second, to preserve the tax treatment, the fund has to hold at least 20% in qualifying illiquid assets, usually real estate. That's a compliance requirement, not a bonus feature, and it means part of your money sits in an asset you didn't choose. Third, access and control. These funds are generally limited to qualified purchasers and have minimums often starting around $1 million. Sarah doesn't pick the basket, and she pays ongoing fees for the privilege. And the one people miss: an exchange fund defers the gain. It does not eliminate it. At redemption, Sarah receives a basket of stocks in kind, and her original low cost basis carries over. The embedded gain is still there, just spread across more names. So why do it? Diversification today without a tax bill today. And the estate angle: if Sarah holds until death, her heirs may receive step up in basis. For money you never plan to spend, deferral can effectively become elimination. Option 2, the direct indexing separately managed account. Instead of buying an index, Sarah owns the individual stocks inside that index. A few hundred names held directly in her own account, managed to track the index. Why bother? Tax loss harvesting. In any given year, even a strong one, some of the stocks in the index are down. Because Sarah owns them individually, the manager can sell the losers, capture the losses, and immediately buy similar stocks to keep tracking the index. Those harvested losses are the fuel. Each year, Sarah uses them to offset gains from selling slices of her concentrated position. Losses on one side, gains on the other, they cancel out. Over several years, she can potentially sell down the whole position with a dramatically reduced tax bill. The advantages over an exchange fund are real. No 7-year lockup, full transparency and control. She can even set a mandate in the SMA to exclude her employer's stock or even her whole industry if she wants to. lower minimums, and when she's done, she owns a diversified portfolio with a refreshed basis, not a deferred time bomb. Now, the honest limitations. Tax loss harvesting decays. As the portfolio appreciates, fewer positions sit below cost. The industry calls this ossification. The loss engine slows down. It works best when we're adding fresh cash or new stock that's vesting, or using the losses early while they're plentiful. One more catch. Sarah needs cash or other assets to fund the SMA in the first place. If all she has is the stock, she pays some tax just to get the engine started. The strategy reduces the cost of diversifying. It doesn't make it free. Which brings us to the third option most people haven't heard of. Exchange Fund Replication. The goal is the same outcome as the exchange fund. Diversification without an immediate tax bill, but without the partnership. Instead of joining a pool, we use options to hedge the concentrated position and synthetically achieve broad market exposure. So how does this actually help Sarah? Two things are happening at the same time. First, the options hedge takes the single stock risk off the table today. If her stock drops, the hedge cushions the fall. Her risk now behaves like the market, not like one company. Second, her direct indexing SMA is running in the background, harvesting losses. And as those losses stack up, she uses them to actually sell the stock strategically, slice by slice, on her own time, not the markets. And compared to the terms of a traditional exchange fund, you keep daily liquidity, no 7-year lockup, no K-1 tax forms, and they're a lot easier to get into. But it's not for everyone. Options add costs, complexity, hedging can limit some of your upside, and this demands a manager who genuinely knows what they're doing. So which one fits you? Lean toward the exchange fund if you never plan to spend this money. If it's legacy wealth and your estate plan means holding until death, deferral may effectively become elimination through the step up. You're trading 7 years of lockup for the cleanest deferral available. Lean toward the direct indexing SMA if you have other cash to invest or ongoing stock vesting, a moderate size position, and you want liquidity and control. It's the most flexible, most accessible option. Lean towards exchange fund replication if your position is very large, your basis is very low, and you want your risk fixed now, not in 7 years. And you're comfortable with more of a sophisticated strategy. For a lot of business owners and executives we work with, combining the direct indexing SMA with the exchange fund replication strategy ends up being the serious contender. And one wild card, sometimes the right answer is just sell some of it, pay some taxes. Taxes are a cost. Concentration is a threat. Don't let the tail wag the dog. Frankly, it's not the end of the world to realize some capital gains tax at today's tax rates because they're subject to change and could be higher in the future. And if we realize some now, we locked in the current tax rate on the amount we realize, and we increased our cost basis. Bottom line, if you're sitting on a large, low basis stock position, doing nothing is a decision. And it may be the riskiest one on the menu. The right structure depends on your position size, basis, timeline, estate plan. Make this decision once with advice before you act because most of these moves are hard to undo. If you want help thinking through your situation, the link to talk with our team is in the description. And if you're following our series on concentrated stock and 8-figure exits, subscribe. The next video builds directly on this one. I'm Dylan Cole with Blueprint Financial Group. Thanks for watching. Bye, everybody.